Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Great to be here.
Today, we're doing a deep dive looking at some key reports from places like MarketWatch, Bloomberg, the Wall Street Journal.
Yeah, we're trying to connect the dots, really. See what's driving the markets, what's happening in real estate, and, the wider economy.
Exactly. Go beyond just the headlines and give you a clearer picture of what's going on.
And it's interesting, when you look closely, you see this kind of tension, right, between, positive market signals on the surface and some deeper economic worries underneath.
That's a good way to put it. You definitely see that in the stock market. Let's maybe start there.
Sounds good.
Okay, so the stock market. It's been, well, interesting lately. MarketWatch and Bloomberg were reporting the S&P 500 had its longest winning streak in, over 20 years?
Yeah, 9 straight days. Pretty impressive.
And what's really striking is this rally basically wiped out all the losses from President Trump's tariff announcements back in April.
Right. MarketWatch had that piece. What recession? Stock investors expect the good times to continue. And they noted the S&P jumped about 10% in those 9 days.
10%, wow, after all that volatility.
It makes you look twice, definitely. But, there's another MarketWatch article, the one titled, "The S&P 500 is headed for its longest winning streak." That adds some, let's say, historical context.
Okay, what kind of context?
Well, it points out we've seen these kinds of fast rebounds before, even during bigger downturns, like back in the 73 bear market or leading up to Black Monday in 87.
So not always a sign that everything's rosy.
Exactly. And get this, historically, after these 9-day winning streaks, the average return over the next 6 months was only about 2.4%.
Only 2.4%? That's not exactly explosive growth, is it?
Not really. It makes you question the staying power of this current optimism. Is it just, relief after the tariff scare or something more fundamental?
And that's crucial because, as Bloomberg reported in their Stock Market Today updates, some analysts are urging caution. People like Tom DeMark, Lawrence Creech-Ruh.
Right. They're basically saying, hold on, the worst might not be over.
Their point being that the full hit from the tariffs hasn't really shown up in the economic data yet.
Precisely. Because most of the recent earnings reports, they covered the period ending March 31st. That's largely before the tariffs really started biting.
So, a potential lag effect?
Yeah, could be. The market might just be reacting to the tariff shock easing a bit, maybe some positive signs on U.S.-China diplomacy that Bloomberg also mentioned.
Like China talking about potential talks again, exempting some U.S. goods.
Exactly. That probably calms some nerves.
Yeah.
But the actual economic damage, that might still be working its way through the system.
Okay, so what about individual companies? Are they feeling it? MarketWatch had an article. These companies are emerging as potential winners in Trump's trade war.
Right. And it shows it's really a mixed bag. Not everyone's affected the same way.
So some companies like GE Healthcare, Abbott Labs, they've actually put numbers on the tariff costs.
They have. But then you got others, big names like GM, PepsiCo, who've lowered their profit forecasts, pointing directly at the tariffs.
Interesting. And that article also suggested some sectors might actually do okay, relatively speaking, like consumer staples, medical devices.
Yeah, potentially seen as safer harbors in uncertain times, maybe. It really shows how complex these trade effects are.
And even the tech giants aren't totally immune, right? Bloomberg mentioned Apple and Amazon had somewhat lackluster earnings.
That's right. And Apple even got some downgrades, partly because of tariff worries and questions about future growth. Shows even the biggest players are feeling the pressure.
Okay, shifting gears slightly, but still related to the Federal Reserve. What's the thinking there? Bloomberg and MarketWatch both seem to think they'll hold interest rates steady.
Yeah, seems very likely, even with, President Trump pushing pretty hard for rate cuts.
So why hold back?
Well, probably because of all this uncertainty we've been talking about. The tariff impact isn't fully clear in the data yet. Fed Chair Powell has talked before about tariffs potentially causing persistent inflation. So they likely want to wait and see.
Makes sense. Play it safe for now.
Seems to be the strategy. Although that Bloomberg piece, U.S. stock futures fall, did mention some Goldman Sachs economists think we might see cuts later this year. Maybe July, September, October.
So differing views, even among the experts. Always the case.
Tells you how uncertain things really are.
And quickly on sectors that MarketWatch winners article mentioned tech, especially AI-related stocks, doing well.
Yep. But on the flip side, Bloomberg noted energy stocks took a hit after OPEC Plus decided to pump more oil.
Right, OPEC and its allies. So lots of moving parts across the board.
Absolutely. If you step back, the market's juggling trade worries, potential slowdown fears, and an unclear path for the Fed. The recent rally was nice, but
But the history and the analyst warnings suggest maybe keeping expectations in check.
I think that's a fair assessment. Caution seems warranted.
Okay, let's switch over to real estate now. There's a really interesting fight brewing, according to MarketWatch. The article, "A Real Estate Giant Wants Sellers to List Their Homes Privately."
Ah, yes. This is about Compass pushing for what they call private pre-marketing, basically showing listings to their own agents before they hit the open market.
And that clashes with companies like Zillow and Redfin who want everything public straight away.
Exactly. Transparency versus, well, exclusivity, maybe.
The article used a great example, this woman, Caitlin Bigelow, in San Francisco.
Oh, right. She tried the private listing first, got an offer, but it fell through. Then she listed publicly.
And ended up getting more offers and a higher price.
Yeah, pretty telling anecdote about the potential pros and cons for sellers.
So Compass's argument is this private approach helps their agents get better deals or faster sales for their clients.
That's their claim. Generate buzz within their network first. But Zillow hits back hard, saying it hurts consumers. Limits transparency, could lead to buyers feeling pressured to use a specific brokerage just to see a house.
And this bumps up against the traditional MLS rules, right? The multiple listing service.
Yeah, the standard rules usually list publicly on the MLS within like 24 hours of marketing it. Compass is challenging that, even sued the Northwest MLS over it.
So they're really trying to change the system. But does the data back up their claims about better prices or faster sales?
Well, according to that MarketWatch piece, data from Bright MLS suggests, maybe not. It apparently shows private listings often take longer to sell and don't get better prices than public ones.
Longer to sell and no price advantage. Doesn't sound great for the seller.
Not really. And then you have agents, like David Bibian mentioned in the article, worried about buyers getting shut out.
How so?
Like, if a house is only shown privately, some buyers might never even know it's for sale, unless they happen to be working with that specific brokerage. It could force them into signing buyers' agent contracts just to get access.
Right, putting buyers in a tough spot. So what's the advice for homeowners caught in the middle of this?
Based on Jeff Jackson's insights in the article, the general advice seems to be, if you want the best chance at maximizing your price, go public. A private listing might make sense only if, say, confidentiality is paramount, or maybe you have renters you don't want to disturb constantly.
But the article also notes more homes are being listed privately now, even without those specific reasons.
Yeah, it seems to be a growing trend, which, raises the question, who really benefits most?
Yeah.
The seller, the buyer, or maybe the brokerage pushing the private strategy.
Definitely something for homeowners to think carefully about. Okay, let's broaden out to some other financial news. Bloomberg had a piece, Aries pulls in $20 billion as investors demand private credit. What's that about?
It highlights a really strong trend right now. Huge investor interest in private credit. That's basically lending that happens outside the traditional banking system.
Direct lending, sort of.
Exactly. And Aries management raised a massive $20 billion in just the first quarter, mostly for their credit group. Their direct lending strategies are performing well. Shows there's a real appetite for this kind of investment.
And they're trying to tap into wealthy individuals, too, it said.
Yep, expanding their fundraising efforts there. It's clearly a big strategic focus for them.
Okay, sticking with investments, but moving to crypto. Bitcoin's been on a bit of a ride, as usual. Bloomberg reported it was nearing $100,000.
Yeah, Bitcoin, BTC, nears $100,000 after reaching its highest level since February. There was a recent rally, seemingly tied to just, more general risk appetite in the markets, plus money flowing into those Bitcoin and Ether ETFs.
The exchange-traded funds makes it easier for people to invest.
Right. But it's worth remembering, as that article implicitly notes, Bitcoin had been pushed down earlier, partly due to the tariff noise. Shows how sensitive it is to macro stuff.
And speaking of Bitcoin believers, Michael Saylor's company, Strategy, formerly MicroStrategy, they made headlines too, didn't they?
Oh yeah, big time. Bloomberg covered it. Michael Saylor's Strategy, MSTR, posts a record $4.2 billion Q1 loss.
Wow, $4.2 billion loss. Why so big?
It was mainly an accounting change. They now have to value their huge Bitcoin stash at current market prices. So if Bitcoin dips, it shows up as a loss on paper.
Okay. But are they backing off Bitcoin?
Doesn't look like it. The article also mentioned they're doubling their plan to raise capital, aiming for $84 billion now.
Doubling down, so they're planning to buy even more Bitcoin.
Seems that way. Very aggressive strategy, clearly. Their stock has done incredibly well since they started buying Bitcoin, but it's definitely a high-risk, high-volatility play.
No kidding. Okay, let's shift to something more concerning on the housing front. MarketWatch had an article, Foreclosures Are on the Rise.
Yeah, that's worrying. It points to more homeowners falling behind on mortgage payments. And critically, the Veterans Affairs Servicing Program, VASP, has ended.
VASP, what did that do?
It was a program to help struggling veteran homeowners, offering things like interest rate reductions to make payments more affordable.
And now it's gone.
Yep. And the article estimates this puts up to 58,000 veterans at a higher risk of foreclosure. Many were already behind on payments, and thousands have been accepted into VASP, showing the need was there.
That's terrible news for those veterans. Are there replacement programs?
That's the concern. Groups like the National Consumer Law Center and the Mortgage Bankers Association, mentioned in the piece, are worried there isn't a solid backup plan. They fear a spike in veteran foreclosures.
And this is happening alongside a general rise in foreclosures overall.
Yes, the article mentioned data from ICE and Adams showing overall foreclosure filings are up too, so it could be a broader sign of stress emerging.
Definitely something to watch. Okay, some big news in corporate leadership too. Warren Buffett stepping down as Berkshire Hathaway's CEO.
That's the news, reported by the Wall Street Journal and MarketWatch. Planning to step down at year-end, recommending Greg Abel as his successor.
A huge change for such an iconic company.
It is, but the reports emphasize Buffett's very confident in Abel, and Buffett plans to stick around, remain involved. Abel's been there a long time, overseeing the non-insurance side.
So the expectation is stability. Business as usual, mostly.
Pretty much. The articles, like that MarketWatch opinion piece, Buffett passes the torch, suggest the core investment philosophy and strategy aren't expected to change much under Abel.
Okay, makes sense. Finally, let's touch on the job market. MarketWatch had a piece, Why There Are So Few Safe Jobs Right Now. Sounds a bit bleak.
It does paint a picture of increasing uncertainty, even in fields usually considered stable, like white-collar jobs, public service.
Really? What's driving that?
Well, one stark stat was zero net job creation in professional and business services this year. That includes tech, finance, a big drop from before.
0. Wow.
Yeah. And the article also points to federal layoffs under the Department of Government Efficiency, DOGE, impacting public sector job security.
Right, under the Trump administration's plans.
Exactly. So experts quoted are talking about maybe moving towards the end of safe jobs due to tech changes, economic shifts, politics.
So even though overall unemployment is low.
Right. The overall rate is still low, but this suggests new kinds of vulnerability are cropping up in sectors that maybe felt immune before.
Are any areas still considered strong?
Oh, yeah. The article did mention healthcare, engineering, and information services are still expected to grow. So it's not all bad news, but definitely a shifting landscape.
Okay, so pulling all these threads together, what are the big themes we're seeing?
Well, definitely the impact of trade policy keeps coming up, affecting stocks, specific companies, maybe even sentiment around housing and jobs indirectly.
Right, and ongoing volatility, uncertainty, even when markets have a good run.
Yeah, that tension we talked about earlier. Plus, you see shifts in where investment money is flowing, like that boom in private credit, the whole crypto roller coaster.
And these broader economic shifts hitting home, literally, with housing affordability and foreclosures, and also changing the nature of job security.
Exactly. They're all interconnected, aren't they? Trade affects corporate profits, affects stock prices, affects investor confidence, affects hiring, affects consumer spending. It's all linked.
Understanding those links is key, really. As you listen, hopefully, you can think about how these forces might play out in your own financial life, your investments, maybe even your career path.
Gives you a lot to chew on for sure.
Absolutely. It's a complex picture out there.
It is. Keeping track of these different trends helps understand the bigger forces at play.
Well, that wraps up our deep dive for today. Thanks for tuning in as we unpacked these major financial headlines.
Always good to dig into the details.
And we hope it was insightful for you. Remember that we'll see you all tomorrow morning with new headlines from major financial magazines.